back to Stupid Money, Episode 2. I'm Ryan, and this is the place where we discuss all things finance, the economy, all that kind of fun stuff. And I'm not here alone. No, I'm here with the boys. The man with the numbers, Tammy. Tammy, how you doing?
Doing well. How are you?
I'm doing fantastic. You got your laptop ready, filled with numbers?
Yeah, just in case.
All right.
In case I forget all the numbers.
Okay. Roger, how you doing today, sir?
I'm doing pretty well. Thanks for asking.
It's good to see you. Well, fellas, let me start here because all week long, I keep getting these articles, and I don't know if it's just my algorithm or whatnot, but it keeps basically, the gist of the article is this. Joseph Biden does not get enough credit for how well the economy is doing. And then I go into the comment sections of these articles because I'm usually on Reddit or whatever, and people are saying this, essentially. They're like, well, I'm sure that's all great on paper, but I'm at home. Eggs are still expensive. Electricity's still expensive. I don't feel it. Inflation seems to be out of control. What am I doing? How can I believe this? So where are we really at economy-wise?
What is our latest inflation number?
3.2, something
which is
like
down.
That. Oh, significantly, yes.
And there is some distinction, to be fair. Joseph Biden, his role in it is pretty negligible.
That's what I hear. Like, presidents don't directly impact your life that much.
It's largely the Fed that controls this, which is a whole other topic in terms of what tools are at their disposal. But yes, so inflation is down 3.2% as of.
Well, that's good.
As of last month, yeah.
Okay, so the clarification here, because I've heard this spun a million different ways and people seem to understand it differently. When we say inflation is down, it means it's down from what it was a month ago. That's not, we were inflated to 9% and now we're bringing that all the way down to where things are getting cheaper. It just means the rate of inflation is slowing. So I've certainly seen people come in and they pick some arbitrary date where they go, I don't know. I was born in 1980, and I remember in 1994, I went to the store one time and I bought a gallon of milk, and it was $1, and now it's $4. So don't tell me inflation is down. It's like, well, that's not how inflation works.
No.
When they say inflation is down and now it's 3.2, that's on top of everything that's already happened. That's from a year ago. Inflation is now 3.2%. So. No, that's not to say that at some point your milk will go back to what it cost in 1994. It just means that hopefully the price is not going to keep rising at the rate it had been over the last year. I think that's an important distinction to make because people get upset and then they say, well, the media's lying to me. Inflation's not down. I know it because I didn't pay this much before. And it's like, and you'll pay more.
Actually, to your point, if you pay back what you used to pay, that's a bad sign.
Right, because now we're in deflation. Right.
And then your wage is going to shrink. And everything else you own is going to shrink. You don't want that.
No, we do not.
So what's the correct answer then? It's like, okay, we want things should always be going up, but only, slightly. But it's never going to go back down. Down bad.
Down bad. I am down bad.
I like to sum it up in very simple terms for people.
What you want to see basically is you want to see growth, the value, what people own in the economy growing up. Because inflation itself isn't bad. What's bad is uncontrolled inflation. Right. That's why economists aim for 2%. Again, arbitrary number. It could be 2, could be 3, not a problem. But when it's expected the new GDP is growing so fast as well to match it, that's not a problem. You won't feel it as much. The problem was GDP didn't grow because of the pandemic, and then inflation spiraled for reasons that we will discuss later on.
Yes, I'm not making much more money, if any at all, than I did the year before, but things are more expensive. That's the issue.
Yeah. Is it the chickens are demanding more money for their eggs?
The chickens have unionized.
They are unionized chickens,
and they are not happy.
I got a letter from the chickens. They're not happy.
But that's where people feel it the most. You can say, you can look at the market, and overall, I'm in the market. I'm doing pretty good, especially this week. But when you have to go do the price of eggs, price of milk, the big memes that people are doing right now, they're like, this is how much I got for this much money at the grocery store. And you look at that and you go, yeah. And then you look at, somebody will find one from the 1950s of a lady laying in groceries, essentially, for that same amount of money.
Of lettuce and eggs, which is not comfortable, but yes.
So I get it, but the financial institutions, it's hard to understand all that what's going on. Plus, we're coming out of a pandemic, sort of what you hope is a once-in-a-lifetime situation.
I'm almost 30. I think I've been through 4 once-in-a-lifetimes.
You know what? Yeah. As an 80s baby, they keep telling me that this is a once-in-a-lifetime thing. But would the economy have done what it done had there been no pandemic? Was it in a strong place before?
Arguably, yeah.
Yeah, it depends on what you're comparing it on. Now, it wasn't bad, but money was ridiculously cheap, and that needed to come down to reality one way or another. When you had your interest rates, I mean, you could, if you look at your credit cards and you compare those rates I used to pay 3-4 years ago versus now, well, it's coming back to reality now. Nothing is free.
Yeah, I mean, it's a nice space. If you're a startup company, for instance, you're going to need what's called a cash injection. You need money to start that business, to buy or to create or whatever it is you do. So when interest rates are really low, we essentially say money's free at that time because you don't have to pay that much on that loan. You're not worried about, oh, well, I need to go out and make 20% profit because my interest rate is so high that I got to pay that back. It's much easier for an economy to be in a growth period, I would say, during a period of low interest rates because, again, money is super accessible. But now we're seeing sort of the opposite. How do we fight the inflation as we raise the interest rates? So now interest rates are up, and then Tammy, you can talk a little bit about kind of what does that do to existing cash?
Yeah, so there's something called the M2 supply, and we monitor that. Well, not us, the economists. We follow economists by monitoring that. But the point of raising interest rates is to make cash less accessible unless you have earned it. And the way you earned it, as Brasher described, is by actually making more return. So if you say, and very simple example, if you don't have much money, you can't buy as many houses because you can't take mortgages easily, right? Now you need to have higher down payments. You need higher cash that you have on hand to do that. That's exactly what it does. It cuts demand. When it cuts demand, inflation drops. Unfortunately, there'll be some pain and some people will be out of job, but that's how the economic cycle works. That's capitalism, basically. Yeah.
So, and again, not to get too in the weeds of how this works, but interest rates go up, and part of that, the Treasury, the government puts out these bonds. It says, "Hey, we're willing to pay you this amount for your money," which is now around
5.5 is the rate.
Okay, so 5.5 is the rate. They say we'll give you 5.5%, which most people would take all day under certain circumstances. So we're offering an attractive rate, and what that does is that motivates, I guess, a decent amount of people to go, great, take my money. And so when you say take my money, that money is now in a vehicle that has a set duration. So that takes out of the M2 supply, as Tammy said, what's in the checkings and savings and money market, money that's immediately accessible and liquid. There's not as much of it, which to the Fed and to the people who monitor inflation, right, see this as a positive sign because it's saying, well, it's hard for inflation to keep doing what it's doing because people have less money to spend. So if you're trying to charge 10 times what you used to charge, good luck getting it because people don't have that money anymore. It's locked up somewhere.
That's how they got me recently. I was at my bank, and they have a big sign that says 5.5 for 7 months in a money market or something. And I'm like, did the math real quick of how much I could throw in there. I'm like, I guess I could go 7 months without this money. And then, of course, immediately after I do that, some big bill comes through. And I'm like, well, can't do it right now. I'm gonna have to. Yeah. So that actually makes perfect sense. It's a weird little system. So they're trying to bait you into freezing your own money.
Yes.
So you don't have access to it.
They basically try to suck the money out of the system, the liquidity. And by that, when they take all the money out, put it in a 10-year, 5-year, 20-year, reduces the M2 supply, which reduces the cash. When there's less cash, people don't have the cash in their hand, they're not going to go out and spend.
Okay, so it's like my money's just like in timeout. It's in money jail right now.
But you're still
making me or the economy in trouble.
But still making you whatever the rate is in that case. So 5.5, you look at that and say, I'm happy doing it. I'll take 5.5 for 10 years. Why not? Right?
Yeah, and it's just being held. Like it's not the government has a plan. It's like, okay, give us money. We're going to make money with the money and do that. It's just to freeze it there.
Well, you can always get out of it if you want.
Yeah.
But it's very attractive, especially how nice the rate is. You're trusting the U.S. government. That's the highest rating possible that you can get. So when you take that money out, it combats inflation. It's like the inflation warrior, if you may.
Okay.
It goes out there and it kills inflation on the way down. And we monitor that. You see, when 2020 happened, we had all the money injection in the system that we saw the M2 really spiking. And then followed by that, inflation spiked, and then both flattened, and now M2 is really dropping very quickly. The government is sucking that out by putting those treasuries out, and people were not really interested to buy it as much instantly. But now we're seeing the demand, because we also monitor the auctions, how the government sells that and people buying it. We see a lot of cash coming in to pick on those. So yes, I would say it is working.
Okay. That's fantastic news. I feel like that makes me a hero by having them hold my money.
You've done your part.
I've done my part as a citizen. But so when that big injection of cash, when everybody was getting stimulus checks, did most of that money go to useful things, or did you find that people kind of spent that frivolously and it just went away fast?
Well, we don't know where. We hope they spent it in a responsible way, but.
I'll tell you, I did not.
I also did not.
Yeah. Like, all of a sudden, I felt like I was at a court hearing, and I did not spend that money the proper way.
But imagine that. If you have all these people receiving all that money without really producing value, because most of us were sitting at home. So now you have more cash and same value, same production value. Of course, you'll see inflation. Not instantly, but lagging in effect. And the opposite is also takes some time to see into effect, and that's what we're seeing right now.
I think the biggest thing that I see on like various like channels and things that I watch is like there's a lot of doom predictors on online and on YouTube and whatnot. And they'll show you a picture of a graph and they'll say, okay, here's the last crash and the economy was good, and then it crashed, and then like, okay, this is 2008, and you see up, and then they'll show it again right here, and they're like, we're right here, ready to go. The crash is happening tomorrow. Now, I've been watching these videos for a year. It hasn't happened yet. You know what I mean? But like, is there any truth to that? Where economy doing good, inflation go down, money goes in, but you do look at these little curves that they have on various stuff, and it's like, oh well, that does look like 2008.
There was when I was in school, I had a very, very talented professor who we used to go to and ask all questions about economics and finance and stuff. And once we asked him about that, something similar to that, the difference between fundamental, statistical, and charts, like studying charts. He gave us, he said, it's like a farmer who wants to know when the chicken is going to lay some eggs. If you do the fundamentals, you see the chicken, you study what kind of breed, what they do, et cetera, et cetera. And if you do statistical, you just observe that chicken and see how many eggs they lay every morning, and you write it down and calculate probability. The third one, which is the chart bits, is when you look at the chicken, stare into their eye, and say, do I feel like they're going to lay eggs? So that's what I think it is.
Okay.
So
and now the chickens, when you look in their eyes, they just look back at you and go, I want more money for these eggs, which is a lot. So I'm out there, like currently right now, I'm in the market for a new car. Right, and I've never bought a brand new car myself. I always just buy used cars because my dad was always like, "You're a sucker if you buy a new car. The second you drive it off the lot, there goes all your money." But the thing about buying a used car right now is there's not a lot of them, and two, I went from A to 2. I know what I did there.
That's not great math.
And two, they're within like about 10 grand of a new car, sometimes 10 to 15 grand of a new car, and have pretty decent amount of mileage on them. And I remember you telling me about this thing. There's called you guys use it like a used car index.
Yeah, the Mannheim index.
The Mannheim. Okay, so when they're not doing steamrollers and orchestras, they're doing the used car index, which I
remember that when I didn't know what a steamroller was, and I thought it was a steamer on a roll, and I imagined a lot of things.
So does the Mannheim used car index is that what I'm going through? Where it's like, hey, there's just not a lot of these right now, and we're going to charge a bunch, or how does the used car index actually work?
It just looks up what you just described. Looks up the inventory, and it see all the loans are taken on there to see how much we have as a price overall of the used cars. And expectedly, when you have higher rates, you'll have lower demand if people have a lot of cars. But if they're expensive, that means the inventory is really, really low, because who's supplying that? Companies, and most of them are all over the world. You have the shipping costs up, you have everything is up. So it takes time for it to adjust as people start buying in, inflation drops, and the economic cycle kicks off again. Because two main things, whenever there is a slowdown in the economy, that we'll see them basically slowing down. One is housing, and the second is cars. And economists look at that. Those
Specifically
two.
used cars?
Well, cars in general. Because those two things, they are the things that you need, right? If you have one, you're fine, but you need. And that when they see the index, how it moves, like, oh yeah, people are getting more or less of those based on the rates. Those are very important.
So it's like you guys are like almost like
Used
your
car
fortune
salesman.
tellers. A little bit. Well, yeah, but most of finance is a used car situation. But so I would decide, I'm like, all right, I'll wait. This feels like I can wait this one out a little bit because it does seem like it just always goes kind of secular, right?
Yes.
Like it's going to happen. There's going to be more. But I sold one of my cars. A man is flying from Michigan to pick it up and drive it back to Michigan. That's how bad of like the market is right now, apparently. That or I sold my car for way too low and I can't figure out which one it is. But it's everybody's got a thing, you know? You can drive your car, but you can't drive your house. You ever lived in a car, Tammy?
I hope
thinking
I
of
won't
an
try
RV.
that, but yes.
I always think like I think it's because my dad was he's an interesting fella, and he went from being rich to absolutely bankrupt like several times in my lifetime, and he probably did it a few times before that as well. And that was like one of his weirder phrases was like, "Hey, you can drive your car, you can't drive your house. Lived in my car before, can do it again." It's like, all right, can we get dinner now? Like, I don't know. But I think that's why I'm always like, I think that's why your job specifically, when I'm attracted to this kind of stuff, because I see the power of money and finance and like having a solid grasp on it and not just like willy-nilly kind of throwing my money into the wind, hoping for the best. You know what I mean? So I like that there's things like the Manheim used car index.
Yeah, right. Even the name is cool.
Yeah. But you were saying there's like a watch index.
There's
as well.
a watch index, yeah. So, when we're talking about there was a lot of money, COVID times, a Rolex, I think, was one of the top appreciating assets of that year, even when the market was screaming, like a used Rolex.
That was in 2020?
I believe so.
Oh, wow.
And I was just seeing there's an index that tracks watch traders, and I think it's the top 20 or maybe top 50 most traded watches in the world is what it tracks the price of, and over the last 6 months or so, that's just
Oh, really?
yeah.
Wow. So are there indexes like this you could find for like everything? Is there like a Pokemon card
There's
index
gotta
that
be.
you,
There's
that
gotta
you can
be.
follow?
Yeah, that's a serious market.
I just found out about vacuum cleaner collection the other
I heard
day.
you just found out about vacuum
No,
cleaners.
yeah, I just found out. I had this dirty carpet, and I was like, boy, I wish they'd come up with something that would get all this dirt
How
off.
do all these people have clean ones? I
Guess
don't
I'm gonna
understand.
live in filth. No. I was watching a show recently, and it's actually this show called How To with, and it's on HBO Max or whatever Max has turned into.
It's just Max.
Just Max.
Yep.
My dad was HBO Max. I'm just Max. And they had a whole section about like people that collect like old Hoover vacuum cleaners, and there's like a whole market for it. Like this one guy's like,
Whoa.
yeah, I've got well at home I've got about 20, and then I got a storage that has about another 200 in it. And it's like, there's a collector for literally everything out there.
Yeah.
Are they functional? Like they're working? Or?
Oh yeah, they were having a convention.
Whoa,
and
convention.
They all brought their various versions of vacuums like throughout time, and then they were super connected to it. There was a lot of older it was all dudes, by the way. There was like no women in this, and there was like a 13-year-old boy who's like, I don't know, I just love vacuums. And they would look
Do you
at all
love
this.
having friends?
Well, that was the thing about it too, because like if you collect watches, you know, you get a Rolex, you show it. It's very much like, look at this, right? But these people, I felt a little bad for them because they were like, well, I've been into vacuums since I was 6 years old.
They're living in a vacuum.
but I couldn't tell anybody about it. Yeah, but I hear the vacuum market sucks. Moving on. So sorry, I apologize for that joke. But you know, I guess you invest in what you know. Do most people do that? Because when I'm out there on my own, when I'm there with my little trading app, like I'm picking stuff that I know
Yeah.
what it is. Whereas,
So-
like, I'll get the tips every so often from some rando, and they'll be like, you should invest in this. And I don't know anything about it, and I end up losing money a lot of times.
Yeah, that's a double-edged sword, as is every investment. But there's actually, a long time ago, I was watching a video of Charlie Munger, who is Warren Buffett's guy, his partner. And he talks about all these different biases. So it's interesting you bring that up because that is one of the biases, is sort of like a familiarity bias. So people, let's say I work for some company and that company's publicly traded. I might go, well, I work there every day.
Right.
I'm pretty damn good at my job. So I'm buying that stock because I know it's going up because look at what I'm doing there from 9 to 5. And it's like, okay, well, maybe the guy who sweeps the floors isn't the best indicator of like how the company's doing. The floors are really clean. That doesn't mean like their books look great.
Yeah. I've seen a couple of people come back from their lunch break a little late.
Yeah.
Selling my stuff.
So that is, yes, it's good to invest in what you know. I mean, if what you know is balance sheets and the health of a company, we were talking about sort of opportunity cost or objectivity, I guess would be the word. That's part of our job, is to be objective. So I can look at you and say, I don't doubt that you do a great job where you work. I don't doubt that you love your job. I don't doubt that it's a good company, but it's probably not the only thing we should buy. I can look at something and say, hey, statistically, as good of an employee as you are, this should not be the only stock that you own. We should probably take a look at something a little more diversified than vacuums.
If it's my money, I'm very attached to my money because
Right.
I had to work at that company that I only want to invest in for that money.
Yeah.
I know all the things I had to go through. I had to sit through so many meetings that could have been emails. And, and I'm like, I know. So my big pile of cash to me is super important, and I'm super protective of it.
Mm-hmm.
And maybe like, especially with like risk myself, I know that I know what it took to get this kind of money. My money wasn't handed to me. So I'm like, well, I don't want to go so crazy, what I would call risky, but I imagine like fellas like you with the charts and doing this every single day, it's like literally your job. You can either explain risk that I can take, or I maybe even like stop me from hurting myself.
Yeah.
You know what I mean?
Yeah. So there's a few really good points to touch on there. We'll start with risk. Some, I would say younger people, so your age in this case, there's this feeling of, I want outsized returns, right? I want to make a lot of money with my money. And some people, that's where it stops. Some people go, well, I see the downside to that, and I'm not interested in the downside, so I'm not going to do it that way. Some people go, I want outsized returns, I want to make a lot of money, and I'm okay with the risk. And maybe they can be, maybe they shouldn't be, I don't know. But the issue is, people will think of, and we were having this conversation the other day, a hedge fund, right? I'm going to get into a hedge fund. And so I asked him, I said, who are the best hedge funds? And he goes, well, you wouldn't know who they are. So that's part of it. Is you wouldn't know who they are. Even they're not consistently beating the market, which is its own separate conversation. But when people go, oh, well, I'd get into a hedge fund because I'm okay with the risk. No, you wouldn't, because you can't afford to. In the words of Warren, you cannot afford. So you're going, oh, I'm gonna risk it all. The people who can get into hedge funds, because there are criteria in terms of net worth to get into these sorts of things.
Oh, really?
Yeah. So
I guess that's why they haven't invited me.
Yeah, I'm sure that email just went to a different folder.
It probably could have been a meeting.
Yeah. But yes, there are thresholds, and so you're going foolishly, in my opinion. I'm okay if I lose all this as long as I might make a bunch of money. Versus the people who are in hedge funds, because they meet the criteria, are in a position where they're not putting everything on the line. They're saying, I'm willing to bet this much percentage of what I have on making a lot of money. And if I lose it all, it means nothing. So there's a difference there of understanding risk. To me, that's not calculated. If you're saying, oh, I'll throw it all on one position, or I'll throw it all into a hedge fund, which again, you can't get into. To me, that's not what risk looks like. And the people who can afford to get into hedge funds didn't get there because they took the risk that this person is talking about. They took risks on working really hard. They took risks on, pursuing higher education to get a higher paying job. They took risks on starting a company to make a lot of money. That's what risk, in my opinion, should mean. Something where you can at least control the outcome of what happens here. And it's a risk of your time, but it's not risking everything you have, because again, you have skin in the game. You have some control over what happens. So if somebody comes in here and says, hey, I don't have much money, but I'd love to have some more, and I'm willing to take some risks, my answer is not, well, let's buy you some stocks. My answer is, okay, what are you passionate about? Can you go do something that makes you a lot of money because you provide a great value to somebody? That's risk. This idea of, well, I'll just throw it. I'm okay with this. You shouldn't be. You shouldn't be, because there's risk you can control, and that's where you should start.
Yeah, one of the more horrific things that I watch is in the subreddit of Wall Street Bets.
I love it
Oh,
there.
yeah.
Do you love it
I
there?
do love it there. I honestly do.
Some of those people do
Keep an eye on
exactly
that.
what you say, though. They the kids call it YOLOing all of your money into like one stock, and then they will post their losses.
I'm familiar.
And I want to jump off a bridge reading it, and it's not even my money, but it seems like that's a strategy a lot of people take who don't that don't have a financial advisor, and they're like, well, I'm young, I can recover, and it's like, dude, you owe Robinhood $200,000. I don't know how you recover from negative money.
Well, and again, I think there's a spot. So, okay, if you're not the guy who can afford to get a hedge fund, which you're likely not, I'm cool with if you're somebody who comes in here and says, I got $400,000, $500,000, but I keep this $20,000 account, and that's kind of my YOLO money. That's my Robinhood account. Mm-hmm. Very rarely do I go, no, we got to have that 20 grand. You can't do that. Because I'm cool with it. I get it. If you want to take your shots, go take your shots. Do it in a way that can't hurt you. If you're having fun, all right, go have fun. And on the off chance you make a bunch of money, feel free to bring that over here as well. But yeah, I have nothing wrong with it. But yeah, those guys, which I doubt the validity of some of that. I'm like, oh yeah, you lost it all. I'm like, how do I know that guy doesn't have $7 million?
Yeah, true. How much of your job though is stopping people from hurting themselves? I mean, like,
a lot.
Do you have to like? I'm sure you hear like the people come in, they sit down, like, I got this hot tip from my friend. it's this fund or this agency or this thing, and from your research, like, and just knowing the person, I mean, that this probably isn't good for you.
Yeah, so that's part of it. There's certainly somebody who comes in and are you looking into AI? Has been the big one lately, or what are you doing with AI? Mm-hmm. It's like, okay, well, everybody is doing something with AI. I don't know what to tell you. But it's more, oddly enough, it's more so in people who are trying to be conservative with their money, trying to be safe, who do it ineffectively. And to me, it's a conversation of, say somebody says, hey, I don't really love risk. I'm going to go buy some CDs. Right? You talked about the CD was paying you 5.5 or whatever it is at the bank. And they say, we'll lock up your money for 7 months. Okay. And they go, well, I don't want to pay you a fee because I can go buy that CD by myself. True, you can. But what happens if it's 2 years from now and rates are down and now you can only get 3? What are you going to do? You're going to go buy a 3% CD? Probably. Versus if you have a financial advisor who's willing to step in and say, well, you can go buy that CD for 7 or 12 or 14 months, whatever the longest you can get is, that's cool. Or we can build out something sophisticated, something vetted, something credible in terms of bonds, where we can get you that 5.5% for, and again, this is hypothetical compliance, we can get you that 5.5% for 10 years. I just paid for my fee and some for the next 10 years because I stopped you from losing that 2.5% you were going to lose once interest rates come down. So weirdly, that's where a lot of our value comes from, is from stopping people from being inefficient. And the other part is emotional, is, the market's down. I want to pull out. Okay, well, let's take a look at things. We have a plan. It's okay if the market goes down. Things still work out in this manner. It's not to say that we aren't thorough and that we don't make good picks from time to time, because I certainly think that we do and that Tammy does. But part of it is not being foolish. I would say at least half of the value we add is not what we do, but what we stop somebody else from doing. And the issue is, if you come in with $500,000 or $1 million or whatever it is, and you hand it over to me, I have enough respect, I hope, for people to understand that that's not just a number. That is likely your entire life summed up into a dollar amount.
Oh yeah, that's birthdays, divorces, weddings,
all of it.
Like the first hug from grandma, last bite of grandma.
Well, it's
like,
the dollar amount that equates to everything leading up to the point where you handed it to us, and it's the dollar amount representing everything that's going to happen from this point on. You know, that dollar amount is likely time. And dollar amount is how do you want to spend your time, and I have a lot of respect for that because I like to enjoy my time. At the same time, I'm far enough removed from it to where I can be objective, to where I can say, this is a good idea, this isn't a good idea, based off of history, based off of statistics, based off of the data that we're polling, based off of the plan that we've set forth. I can hopefully appeal to the emotional side of somebody enough and know them well enough to where they trust me to believe me when I say that things are going to be okay, to stop them from doing something that's going to be detrimental to themselves down the road. But it's a weird balance, right? Because I spend, I would say, 80% of my client meetings talking about life. I'm not, the portfolio, that takes not too long to go through. And if you have questions, great, we can dig in a little bit more. But the type of client I like is somebody that's coming in and talking about trips they take and talking about experiences they've had. I don't want somebody who's scared. I want somebody who's living, who's enjoying themselves, because that's how I like to, again, spend my time. That's the type of people I want to be around. And so that I can understand them enough for when that time inevitably comes, when things get rocky, where I can use my objectivity while also using the fact that I now know you to say, hey, here's why things are going to be okay in a way that you can understand. But it's a tightrope to walk.
I just thought it was interesting. I mean, it's got to be, it seems so obvious. Like, you deal in money. Your job is to take people's money, make more money. But people seem to be scared to give you money because they're like, well, if they don't make me money. But
in that voice.
That's the voice that they use, yes.
You met that man.
Yeah, he's a great guy. He didn't...
Funny voice, great guy.
Yeah, he's telling me all about his trips and things like that, and I was like, "You just told him about that." So it's a lot of psychological, diving into them. So you're literally having like almost like a friendship, like relationship in the purest way with your clients, because you have to know them on a real level.
Yeah.
It's like barbers don't just talk about hair the whole time they're cutting your hair. You know what I mean?
Right. Well, I mean, you don't have to. You certainly don't have to. Anybody could walk in here. I could say, yeah, A, B, C, D, and E fund, I think, will be great for you, and we'll talk to you next year. You can absolutely do that, but that doesn't help me. That doesn't help me help them.
That wouldn't help me. I wouldn't like that. If I came in there like, all right, sit down. Here's these funds. Pick one. Go ahead and buy. It's like,
yeah.
Did I just get bamboozled?
No, a lot of people do that. But again, I don't. I like people, I like living, I like people who live. So that's what I base 80% of what I talk about on, because that's what I think people are coming to us for.
Mm. Well, I mentioned you also have to make like a level of trust. Mm-hmm. There has to be, because if I'm giving you my entire life savings or something close to it, I have to be able to trust you and know that, like, you know what you're doing, and if you just hand me something that's like kind of boilerplate and it's like pick A, B, C, or D, that doesn't establish trust.
Yeah, I mean, it takes a lot of time to establish some trust. I would say for a decent amount of people, it's a leap of faith. The first time you come in here and you say, "Yep, take the keys," I'm sure that's a little scary. Where I think we build trust, or where I try to build trust, is, again, it's getting, and it takes time, it's getting to know somebody. But I know now who my clients are, that if I start to see something that might scare them, might freak them out a little bit, I'm calling them before it happens. And I don't do that for everybody, because some people I say, hey, yeah, if you need a little hand holding, I'm here. I've had some people go, please don't call me if that happens. Please leave me alone.
Oh, really? They're like, I don't want to know the bad news.
No, and that's the difference. And it's knowing how to communicate to somebody. It's knowing how to, I mean, even if we're talking about, let's say it's bonds. Let's say somebody's got their income covered by Social Security and they're perfectly good, and they just want some bonds, and it pays a coupon. And at the end of the year, that gets them $10,000. And I know they really want to go to Japan. There's your flight. That's the communication I need to have somebody. I need to know what's important, because likely the word 8% or down 3 or up 12 doesn't really mean much to somebody. A dollar amount might. Actual life usually means something as long as you frame it correctly. So if I know it's Japan, if I know it's Iceland, if I know it's a wedding, when I can put a number up and say, that's what that is, that's what it is in your life, that makes it much easier to communicate effectively with somebody.
I like that. I'm now going to do all of my currencies based on like how far I can travel. Like,
I think I owe you a cheeseburger.
How you doing financially, Ryan? I got a trip to Sanford. It's pretty good. Just next town over. Doing all right. It's so funny though, because you do have to live life experiences. I expected when I first met all of you guys, like you're going to be like, you have to take your money and you have to hold on to it and don't spend on anything extra. Whatever you do.
That's not the client I want.
That's not.
That's not, and you know, some people can be coached out of that. That's cool. We actually just talked to an advisor the other day who said, if I ever catch you sitting in coach, I'll fire you. I don't want you as a client anymore, which I like to think we're the same way. You know, there's a lot of people who have been so disciplined for a long time and saved to get to this point, and now they're there. And everything is fine, but they've been so used to being so disciplined and spending so little that it's scary for them to think that they can start to do those things.
That's what's going to be my question is like, do they know that they're there? And is it a different feeling? Do you have to like talk them into like, hey,
yes,
you're a millionaire, by the way?
Yes. And the amount of people who are surprised to hear that is always funny. The people who have no idea. You know, people walk in, did you know you're a millionaire?
How do they not know?
They just don't know because they never, you know, they just kept their head down. They never looked up. And usually that's worked out for them. It's now getting them to lift their head up and look around and go, oh, we're in a pretty good place. I'm glad I looked.
I just hope they're not like, I spend all this money now. And they just go right back to zero.
No, usually it's much, again, it's one of my favorite conversations to have to try to convince somebody to have more fun. But yeah, I can think of a handful already off the top of my head who we are presently in the phase of please go do something. Mostly because, again, it makes the meetings more fun when somebody comes back and says, I went to Thailand. Oh, okay, what was that like? As opposed to, I watched Netflix. I'm like, yeah, I saw that one too.
I feel like if you did that to me, I'd be like, where's the camera? I'm being I'm not a millionaire. But I imagine though when you say like a lot of people are like kind of like secret millionaires in a way, it's because if you added up their like house, how much they had, 401ks, and you add up all of those numbers, it you know, not liquid millionaires.
Some have, you know, because they have accounts in other places and they've just never stopped to look. Usually the house obviously plays a factor into it. People have been diligent with their debts. But yeah, a lot of the time you go, did you know you're a millionaire? He goes, no, I didn't. Then
Fun fact.
Occasionally you get somebody who goes, yeah, I thought I might be. Just a feeling that went off one day, like, oh, I think I might be a millionaire.
Yeah. Do you guys have like a little button that you hit, like, and like balloons drop down? Because that would, I think you could implement that.
We usually try to we usually try to give our clients a book once they pass a threshold as a little celebration. But yeah, it is surprising the amount of people who, again, never stop to look up.
That's funny. I think it's just because like being young and not having it, like, you know, like we go pull out the ATM deposit and you're like, hope there's enough there, you know, and then like to now being pretty okay in life, and I actually don't know what's in my bank account right now, and then like the other day I added up my 401ks and all the different stuff, and I like added in, you know, the value of my home, and I'm like, doing all right, man, good for me.
Yeah. Well, I think it's usually the people who pay themselves first, meaning before, you know, like when they take into account a budget, it's not, oh, I spend this much, and if this is left over, then I'll put that into savings, or then I'll put that into a 401k. They do it immediately because that's not part of their budget. That money doesn't exist to them.
Right.
Which is a pretty smart way to do it.
Yeah.
You can't spend it if you just immediately take it out.
Yeah, mine just goes out, and I'm just like, okay, this is what my check looks like.
Yeah.
I don't even think it should be like $300 or $400.
No, I have no idea minus my 401k what my paycheck would actually look like.
So what is like your ideal client? I mean, like, because it sounds like it's wrong from what I thought, which is you guys only deal with millionaires. Like that are straight up rich people, monocles coming into the office, like, yes, I need your help.
Monocle required.
Yeah, monocle required, or you get one on the way out. I don't know how it works.
I don't want them too rich. I don't want I don't want the monopoly man.
But is it your standard like middle class people that should be doing this, or is?
I mean, I certainly enjoy. There's different. There's definitely different levels and different approaches for different kinds and levels of wealth. Scott, who built this business, I think it was basically the blue collar billionaire. You know, he would always say it's the kind of guy who maybe was an electrician and at some point accidentally started a company and then accidentally made a lot of money. And because it was never really supposed to happen, it was just a guy who worked hard and happened to have some good sensibilities. The financial literacy probably wasn't there. So he viewed it.
Business and finance don't go together like you think they would be.
Weirdly, they do not. So then it becomes our responsibility to say, hey, look, this great thing has happened. What do you want to do from here? Are we taking care of generations? Is that the goal? Is it just we want to go have some fun? So those people are extremely fun as clients in my head, because it's people who are aware of the limitations of their limitations, which makes it much easier for us to do our job. And it's people who are usually pretty smart and open to being educated. Once you get into sort of generational wealth, that can be a different conversation, because depending on the level of it, what's necessary from a risk perspective and from a gain perspective changes. It's maybe not so humble beginnings in somebody who is more literate, most likely. So now you have to find more exciting vehicles while also respecting the legacy of what that money is and making sure that legacy continues to exist while trying to make some money.
I always, I guess, assumed too the most difficult part of your jobs would be like it's the math and it's the numbers and the calculus of it all, but it sounds like that's not the case.
I was telling him earlier, I'm not when the market goes down or a stock does whatever a stock is going to do, that doesn't scare me. I'm not scared of the stock market. I'm not scared of the research that we've done in our portfolios. I'm not scared of history. I'm not scared of statistics. What I am scared of is not appealing enough to the emotional side of a client's experience to where they then do something foolish that hurts them in the long run. I'm more scared of people than I am of numbers, because the numbers, historically, statistically, do what they're supposed to do within a certain range. The plans do what they're supposed to do within a certain range, but there's a behavioral element to every single plan. And I can't quantify people's behavior so much. So that's what I worry about, is am I doing enough to make a client comfortable to where they're not going to hurt themselves in the process?
Wow, they're like little financial babies. They gotta take care of it. You gotta pad up the little wall so they don't hurt the little financial knees.
You do, and that's that's a risk conversation. Everybody's a little bit different of making sure somebody's comfortable at the start.
Risk for me, like, is such like an ethereal word, because like you always hear like, can you handle the risk? The risk. I mean, can you kind of just explain what like the actual risk is on like a real level? Like, what is the risk? It's just like going to zero? Is it just losing some? Is it?
Yeah,
I don't know if I'm wording this correctly, but like risk is just, it seems like this all-encompassing thing. So when you say like, oh, I'm going into like a high-risk scenario because I'm young, does that literally mean, that weird third world diamond mine that this is invested could blow up?
Yeah, I guess. First of all, virtually everything can go to zero. Mm-hmm. Apple it has the capability of going to zero. Statistically, probably not super likely. So that's part of the conversation. But yeah, to me, really high risk is I'm going to go buy a very, very, maybe it's a penny stock, and I'm going to put a bunch of money into it because it has so much room to go up. Well, it's also not too far from zero already. So that's high risk to me. lower risk is just looking at statistical tendencies, right? As saying from a accounting standpoint, I don't see anything that's concerned about this company going away, but it doesn't mean the price, maybe it's in a sector that's volatile, or maybe it's in a stage that's volatile, but we know the company is safe. Can you handle the risk of, it might go down 20%, but we know statistically it lives within this range. Are you comfortable with that? Or are you going to freak out when that happens? And if so, then this probably doesn't work, because most plans don't work if you don't stick with them.
Is risk, this is probably a stupid question, but is risk fun for you guys when you get to do, when somebody says like, hey, Tammy, I want to be risky today. Let's do this. And you hit whatever button you hit, the risk button, you're like, woo!
And then you got those sirens.
Yeah, and it goes off. Or is it all kind of the same transactionally for you guys? Or do you get a little skip in your heart if you're going, we're going risky?
We probably have two different sides of what that experience is like. Yeah. And you feel free to chime in on your side. On my side, it's totally 50-50. Somebody will say, oh yeah, I love risk. Bring it on. Bring on the volatility. And then it goes down, and they go, wait, why did it go that way? I thought you meant volatile the other way. It's like, oh, God, okay, you weren't ready for this. So, yeah, that's always
because I imagine it's like, when you say risk, like, people aren't really thinking about, like, what that really means. Like, I don't go into a situation, like, let's say I'm going, and I'm like, okay, I hear there's risk, but in my brain's going, number goes up a lot. That's what that means. And it's never like, number goes down.
Yeah. Yeah, I mean, we run tests. We have tests and softwares that'll show, like, okay, according to, it's usually like the Great Depression or 07 or 08. Say, here's what would have happened in that period, which are historically not great periods to be an investor. Mm-hmm. And it says, you put in this amount of money at that time, it would have gone down to this amount of money. What would you have done? So, and again, that's hypothetical. People, even though they see that it's their dollar amount and then it's this, they still know that I'm tricking you, that it's not real. And so they can give me the answer they think I want to hear. Like, I would have been fine. Yeah. It's like, okay.
I'd have been good. You don't know me, bro.
Yeah. There's, just to chime into this, as you mentioned, risk is a pretty loose term. There are so many more particular risks involved with different ways of investing. So if you put it in stocks, if you put it in large cap, small cap, bonds, what type of bonds, etc., each of those has, well, say, its own set of risks. Combined, there is a, let's say, not quantifiable, but there is a way that we can kind of keep it within certain parameters, but they're totally different. So that to keep in mind into what risk can be. It's a whole thing, and then there's a whole thing called risk analysis and risk management.
Yeah, but I imagine that's why diversification is so important.
Because you're diversifying your risks as well.
Yeah, because if one goes down, maybe you're making up with the other way. I'm glad you guys do this and not me. I play what I call most of the time just the gas pump stock market, where if the gas is low, guess what? Full tank, baby. But if I see it gas high, I'm like, it'll get better soon.
That's smart.
Quarter of a tank. I do
more walking.
I do it in my own little way. But speaking of like the 2008, right? So let's say you were invested in the S&P 500, 2008. Mm-hmm. You get in right there, it crashes. You were there before it goes down. Mm-hmm. Didn't it? Correct me if I'm wrong. It not only went back to where it was, but then like better.
Yeah.
Correct. So crash. People always say like, can you always outweight risk? Minus like a company obviously being completely bankrupted, which I feel is the rarity.
Yeah, I mean, a well-diversified account. So far, yes. Statistically, what is it, a 10-year period? You'd be hard-pressed to lose money.
Yeah, in the index. Yeah. And that's what you say here is the price risk. But there's default risk, there's inflation risk, there's reinvestment risks, and there's way more other kinds of risks that we put into consideration when we do stuff like that.
Yeah, yeah.
I had one company go to zero in my little app, and it was like, I guess it died. And I looked at it like it was going to come back to life. Like I kept like pulling it back up, and I'm like, it still says zero, but that's
It's not like zero.
Where did it go?
Like giving it mental CPR.
Sell some office chairs or something, dude. Give me some money. So that's the only time that's happened to me personally. But it was like losing a tiny little. I wouldn't say friend. It'd be like I would call it baby bird because I didn't have like a whole ton of money in it. But it was the first time I realized like, oh, things can just end. And so when you guys invest, is it always like the bigger kind of like stable companies, or is it just across the board? Or I guess there's no one answer. This is what I've learned with you guys. There's no one answer.
Yeah.
It's going to be bonds. It's going to be
depends.
Yeah,
It always depends.
But that's got to be difficult. Is it stressful doing your guys' job?
I wouldn't say it's stressful if you're doing the due diligence, but it is a lot to process, yeah. But it's not as stressful.
So you don't wake up in the middle of the night and go, Apple!
Well, I would say if you do that, you're doing something wrong. You shouldn't do that.
Again, my stress is not numbers. It's people. Some people's plans are easier than others, and others people's plans require a lot of discipline and monitoring. And that's the only thing that stresses me out is for those people where I know they have a worrying tendency, and their plan does walk a fine line that I feel confident in, but know that they might get scared. That's the only part that's stressful, is because I hate to see somebody, especially kind people, which I like to think of the vast majority of our clients are kind people that I do legitimately enjoy spending time with and talking to, and I root for them. Yeah, that's the only thing that stresses me out is this person going to cost themselves?
Yeah, well, again, because a lot of your job is to stop people from doing something dumb to themselves, right? So
Yeah.
I imagine, like, if I was in your position, what I would wake up in the middle of the night and be like, I couldn't get somebody to not walk away. I know this is the best, and they did, and because you get to see, tomorrow there's a new day. Chart's still gonna go, and you see whatever happened, maybe whatever graph or whatever line goes down. You're like, I could have stopped them.
Yeah.
I'm eating my spaghetti and I'm thinking about Frank because he walked away. Does that ever get to you?
Yeah. Yeah. I mean, I've certainly had a couple of instances of, I get why you're walking, and I've tried to talk you off the ledge a number of times, and the numbers don't point to the decision you're making. You're making a decision that's coming from an emotional place, which again is understood, but I legitimately worry of what happens to you in 5 to 10 years when this plays out the way it looks like it's going to play out because we've walked away from the plan.
Does emotion have any place in investing, like raw emotion, or should everything sort of be analytical and like?
I think emotion should come into play in the planning of, okay, we say we're going to do these things, whether it's I'm going to invest this much. Okay, well, is that such a big sacrifice that you won't enjoy your life until retirement, right? Because I don't want that, because what if you don't make it to retirement? So that's an emotional decision.
That's the one that gets me up at night.
Do we need to be investing more because you're saying, oh, well, once I retire, I'll stop doing all the things I love? No, you shouldn't. We might have to change something behaviorally, but you shouldn't. Those are emotional decisions. And divorces. Divorces are also emotional decisions.
That seems okay. Yeah, that of all the things is just like my anecdotal evidence is the worst thing you can do financially is find a bad partner.
That is true.
And not enough people. Yeah. I don't think they think about like it. They don't ask like, "Hey, are you good with money? What is your credit score?" And I'm not saying that negates somebody from like being like a romantic partner, but I think like you should be like, "Oh, well, my credit score is like 570," and you're like, "Ooh, okay, I love you. Let's also focus on that."
It took, and if she sees this, she's gonna hate that I'm saying. It took me and my significant others 2 years for me to figure out what was in her bank account. Because the way she talked about it was like, "Oh my God, like, are we gonna be able to pay the mortgage?" And then she told me, I go, "Are you serious?" I said, "You've had that this whole time?"
It's bad. Like I remember like like with my now wife, like I was so scared to tell her my credit score at the time, which was like, it's good now. I worked really hard on it, but at the time I was just starting to figure out how important that was, and I knew what hers was because she let it slip one time. Yeah, and I almost was like Prince and the Pauper situation. I'm like, I'm not good enough for you with this number. And I remember like we sit down, we're at a Carrabba's, I'm eating spaghetti, and I'm just like, I tried to say it fast, and I'm just like, so my credit score is like this. And she's like, what? And I'm like, yeah, can we still love each other?
Yeah. Well, I think
but
most
because
of us,
I've seen relationships fall apart from
it's
like
the second leading cause.
Yeah.
I think of it's what, infidelity and financials.
Yeah. Well, there's a thing. I believe financial infidelity is a thing.
Yeah.
Like people lie about what they are spending on or like where they're at debt wise.
Well, even your expectations need to, I think, be part of the conversation. Like, what is our expectation of life? Mm-hmm. And what do we need to meet that expectation? If one person's going, my expectation of life is I'm going to spend 20 grand a year and I'm going to eat ramen and I'm going to be perfectly happy doing so. Like, that's cool. But maybe you shouldn't be with somebody who goes, well, I want to go see the world. Because financially, those are two very different situations, and you're likely going to have two people who are very upset with the other's expectation of themselves at some point in time. So yeah, I think as taboo as it is, at some point, you got to start talking about some dollar figures.
Yeah, one of the weirder parts of my life recently was like...
I love where this is going.
Sound crazy, but like she's a lady who likes to leave all the lights on, you know. So I come home and all the lights on. I found myself doing this, racking up the electric bill, and then I'm turning off all the lights. I'm getting mad.
You're just like your father.
And then I realize I take a step back and I go, I sound like my dad. And then I think about both of our financial situations, both of our jobs. I know what we have in the bank account. I go, stop it, Ryan. Just like
leave the lights on.
Turn on more lights. Yeah. You know, it's actually, and the funnier part was like figuring out because we replaced all our lights with like LED lights, right?
I've done that.
Yeah,
very bright.
It is. It's a bright move.
Yeah,
and I found out that like just running a TV for like, I think it's like 4 hours, you could leave like one house light. It takes a whole year of that light being on in a house for like the TV to be on. And that made me feel so much better about life. But also then mad about my dad. Killing about that. But I also had that moment too, because you know what's not cheap is the AC bill. And I finally, as an adult, got to yell this. Door open, she lets the dog out. She's just like in the door, and I'm like, "What are we AC-ing the whole neighborhood?" And then I was like, "I've officially become an old man. Feel better."
That's a tough one.
So you know, that's just irresponsibility. But you know, when you can afford, that's how I feel like rich people are. They just open up their back door, AC, and like it's no big deal. Have a great day, everybody.
They walk out like it's hot out here, then they open the door.
Yeah, I guess the last question, just for my own curiosity before I get out of here.
What's my AC bill?
Yeah, what is your AC bill? And do you want to buy solar panels?
I was just having this conversation. I know.
Are millionaires different in like personality? Is there something brain wise that you've noticed that makes like a person who is a millionaire, becomes a millionaire through retirement, different from like your average Joe?
I mean, there's different kinds of millionaires. You know, there's the millionaire who started with nothing and now has $1 million, and there's a millionaire who started out with 5 and now has 1.
Yeah, I guess.
So there's different kinds of millionaires for sure.
I guess what I'm looking for is there like is there just a certain kind of person that's gonna become a millionaire, and if you're not this kind of A-type personality, then that's not for you, man.
No. I mean, I'm a firm believer that most people have something to offer, and that can likely be monetized. But
we'll put that on a shirt.
Yeah. No, I don't think there's any one type. You know, there's type A people, there's type B people who make a lot of money, and you know, it might be somebody who made $500,000 a year as a business owner and maybe wasn't great with their money, but they have $1 million. Or it might have been somebody who was making $80,000 a year but was really diligent. So no, there's no one type, and there's a million different ways to get to the number 1 million. So yeah, if you're going, well, I'm a type B, I'm a quiet person, I won't make $1 million. You might, you could. There's nothing stopping you. Not every type A makes $1 million. So yeah, there's no capitalism. maybe not capitalism, but the number 1 million doesn't really discriminate based off of much criteria.
Second question is, when you see, are you always thinking about how you would invest money in the way of like this? Like I saw Texas coach Jimbo Fisher, he gets fired, right?
Once great FSU coach.
Once great
Jimbo
FSU
Fisher.
coach, went undefeated.
Yeah.
But he gets fired. He gets let go from his job, but he still gets the money, right?
He gets $75 million still.
$75 million, which is $26,000 and some odd change a day, right?
Not that you did the math, but
Not that I did the math because it made me mad. But it's do you see? So you look at that number, you read that in the paper, and you go, well, $26,000 a day. I know what I would invest that in. Do you constantly have that in your brain at all times, or can you let it go on a Sunday morning?
My first thought was he never should have left FSU. Now, FSU's
that's a different argument.
That was my first thought. $75 million.
Because he wants to still coach, right? So, but
Probably.
you obviously could coast on that for not only the rest of your life, but like 12 of those lifetimes.
Yeah. I mean, that's not really my world. I don't live in 75 million world. I have thoughts for sure. I have what I think I would do, and then I probably have a few people I would call to ask what I should actually do.
What does your retirement look like?
What is my retirement in terms of what would I like to do?
Yeah, what are you going for? I mean, you're dealing with everybody else's retirement all day long.
It does make you think. I'll be honest. It does make you think. Like, oh, I like the way he's doing it. I don't like the way that person's doing it. My retirement.
Is it beach cocktails and?
I'm not a big drinker.
Sitting on that.
No, I'm not much of a drinker. I probably have a handful of guitars. I'd like a little studio where I can go in there and do my thing. I'd like to. I'm really into traveling right now, as Tammy is well aware, because I bug him about it every day. So yeah, I like to go maybe, I don't know, once a year, go somewhere else and see what those people are up to and how they're doing the things that they do, and see if I want to steal it. I don't know. I don't even have, I have no idea.
Interesting. Tammy, what about you?
Definitely traveling. I have already a set of destinations, but not just go and visit. I want to go and live there.
Oh.
Like a month. Here, a month there. Treat the food, talk the language, see how they live life.
We already speak 42 languages, Tammy.
41.
How many more do you need?
And a half.
Yeah, I found that like when I ask most people that question, it is a lot of traveling. And I wonder if that's changed over time where, like you think of a classic like 1950s, 1960s person, they're like, yeah, I'm going to kick back on the beach and stare off into the ocean, have my Mai Tais.
Hurts my eyes.
Too bright. But I think like most people now, they're like, they do want the experience, because if what you can buy financially is great and all, but like you really can't buy experience, you can't buy time. And I wonder overall, has that changed for the majority of people?
I mean, it always an interesting thing that's happening right now, and I'm sure it seems like it's happening to my family as well, but you find some people who made a decent amount of money, and then they have kids, and then they go, oh, I'm going to go build a dream house. That's what my retirement looks like. It's a dream house. But the second the kids have grandchildren, they go, well, I'm not going there anymore because the kids are over here. So that's why I say when I say I don't know, because I'm 29 years old, a lot could happen. If there's a family that I enjoy, which I hope I do, then I'll probably want to spend some time with them. Also, I know at least thus far in my life, like 11 days is probably my max travel at a time. Because then I get weird. I need to go do something. I'll probably if I had to guess, I'll find some way to work. I don't do well not working.
That's funny. I think 11 days is actually pretty accurate, because once it starts getting into like the 2-week territory, I'm like, I would like to go back to work now.
Yeah, no,
which is an odd way to be.
About day 3 or 4, I had a weird day in Italy where I was like, what the hell am I doing here? I'm not doing anything. I'm just sitting here and drinking and eating, and I should be doing something. So that was weird. And then by day 10, I was like, I need McDonald's. I need it. The last day we spent in Milan, I had McDonald's in a hotel room in Milan our last night.
In Italy.
Yeah. Well, I did hear a fun fact, and this is true, that 100% of potential millionaires actually subscribe to this channel and follow this podcast. That's true. Potential millionaires.
I'm so curious to see what compliance thinks, if that's true or not.
I mean, it's all up in the air. They have the potential to do that, compliance. I will say that. I like to think when you guys mention compliance, by the way, that there's just one guy, and his whole job is to just listen to this podcast, watch this show, and he's like, can't say that. Gonna have to email him about that. And his name is Brad, and he's the worst. But if you want to get a hold of these fellas, how do someone get a hold of us for stupid money and to become a client even?
Yeah. If you want to get a hold of us, I guess you could email us.
Email works.
Yeah.
Yeah. We have email.
We have an Edgewater Family Wealth marketing email. You can also go on the website. There's a bunch of different kind of contact forms depending on what exactly you're looking for. If you just want somebody to talk to and tell about your day, that's Tammy. If you want to talk about financial planning, that's somebody else. EdgewaterFamilyWealth.com is probably the most efficient method to find exactly what it is you'd like us to do for you.
All right. So go there, and we'll see you all next time. We'll be back with more stupid money.